David Pearce has joined us, Director of Strategic Initiatives at GPS Capital Markets. David, as we get going here in Europe this week, we're just dealing with another banking resolution, the third bank that has been wound up, and now it's also been bought by JP Morgan. Quite a backdrop. We've got central banks deciding whether to constrain further credit to the economy. What do you think the significance is of the story around First Republic as central banks sit down to make decisions on whether to raise interest rates again?
Well, obviously it's very impactful, and it impacts all of us. And if you listen to the political side of this, you would have them tell you that it really is a non-issue because it's all covered through the FDIC insurance, but money has to go into that, and they're insuring deposits well above what the insurance covers. And on the flip side of that, you look at the deal that Jamie Dimon made, and I mean they got a great deal in their purchase. So that all impacts us directly financially. But when we look at it on the broader market, what I really have big concerns about is that the Fed is not necessarily doing their job in supplying and regulating and making sure that there's adequate money supply for these banks. This all shouldn't be happening in a vacuum, and it feels like this is all just coming as a surprise to people at the very last minute. And the regulators should know a lot closer what's going on with these financial institutions. It should not be happening in a vacuum like this, and it makes me question a little bit why did they have to take them over and sell them all over a weekend? Could they have funded them and given them additional capital, provided them, loans that would have got them through this hard time? And that's, those are the questions that I think we still have out there. Additionally, if we look at what's going on with the bank situation, Jamie Dimon comes out and said, this is it, this is the end of it, we're all good now. I don't think we can really say that yet, because we don't know what other problems might be lurking. And obviously, there's some things that are hidden. And a lot of this also comes down to there's been some mismanagement of these banks. The banks that have really taken the big hits are really, they back a lot of the high-tech industry, a lot of, and because they're in the tech world, they've been hit a lot more, I think, than they would have if they were anywhere else, because they have a lot of their eggs in one basket. And so when you see blips, there tends to be a lot more panic because they're not spread across a bunch of different industries.
David, hard to argue that this is idiosyncratic or one-off when we've now got the body count at 3 on the on these major banks. In terms of what it means, though, I mean, in the wash-up of SVB, we saw the market saying, well, that's it. The Fed cannot possibly be hiking after this. And then we saw banking turmoil start to settle down, and the markets quickly started to price back in the 25 basis points that we're looking at for this week. But it just does tell us how it can be quite key. The market perceives the financial conditions in the backdrop, and if there's more coming, then it does put question marks over the rate hikes from here. What's the playbook for the Fed? Do you think one and done after tomorrow?
I cannot imagine how they can do any more than this quarter point raise, because it has caused so much turmoil in the marketplace. And frankly, we haven't seen a tremendous amount of effect for reducing inflation and doing the things that they've been trying to do with raising the interest rates. This would, represent a 5% increase in interest rates over the last 14, 15 months, which is massive. And for people to just be able to absorb that, being able to pay more for things if they've got a floating rate loan and their credit cards and going out and buying homes, people still seem to be absorbing that, and we're not seeing a high rate of personal bankruptcy. But that can only go on for so long. You were talking a little bit about macroeconomics earlier, and how people have not been keeping up. Wage increases have not been keeping up with inflation, and that's a problem, and that's starting to hurt people. But I think people have been doing well enough that they've been able to survive this. But you've got to ask, how long can we keep this up, and what is going to be the long-term implications of this?
David, lovely to hear you today. Thank you very much indeed for joining us. Look, just a quick question from me as well. The amount of money on deposit has just shifted from certain regional banks to let's say, the systemically important banks. So the amount on deposit, no one's lost a bean on deposit just as of yet. But the question is that capital as available for various sectors and various individuals and various parts of the economy as it was before? And so the big question ahead of the Fed later this week is the capital markets, is a constriction in those capital markets doing the job of the Fed for it? And actually, is there less liquidity available for all kinds of sectors? And if so, what is the ramification for valuations?
Yeah, I think there's two things going on there. And the answer to your first question is there has got to be less liquidity in the marketplace. If you look at the three banks that have been taken over, all three of them really catered to the tech industry, and they knew that world very well. And a lot of their clients were, pre-revenue, pre-profit, and the kind of clients that traditional banks just do not lend to because that's not part of their portfolio. Those banks really understood the risk on that. They charged a lot higher interest rates for that, but they were getting good returns. And it was not their normal everyday banking that put them under. It was how their internal investment, their people in their back office, how they were investing the capital and the deposits that they have that really took these banks down. It wasn't their daily, day-to-day operations. So if you look at how they were operated, just going out and dealing with customers, all of that was very well done. And they gave a lot of access to money to people that otherwise would not be able to have access to that. So, yeah, I completely agree that it has really reduced the capital in the marketplace, especially available to high-tech companies. Second point I want to make is that the Fed, almost by default, is telling people you don't want to have your money in a smaller institution. You want to move it to one of these big banks. And in some way they are, they've kind of caused this problem because a lot of people have been pulling money out of these smaller, mid-sized banks and moving it to the big money center banks. Just because that's the message that they are getting from the government, is that that's what they should be doing. And in some way they're I hate to use this word, but it feels like there is a little bit manipulation going on. If you're an investor, you'd want to have more of your investments in the big money center banks rather than in the smaller and medium-sized banks, because that seems to be the government's preference right now. And, I don't know that the government should not be their business. They should be agnostic, and they should not be trying to give favoritism or even the perception of favoritism to one type of institution or another.
Absolutely, David. As we were talking about earlier, it does create further moral hazard in the markets. I just want to reference some comments from the HSBC CEO. No nasty surprises in Silicon Valley Bank UK loan book since acquisition. Also, we do not see a negative impact on our business as a consequence of the First Republic rescue. So that gives us a sense of how another big bank CEO is thinking about these arrangements. David, I want to just take you in a slightly different direction, because I think the RBA has set the cat among the pigeons a little, because there was a whole community of central banks that appeared to have moved to a pause in the interest rate hiking cycle. And now the RBA has pushed the button again. And I think it's raised concerns more broadly about ultimately where are we going to top out on interest rates. So as you look around the major banks and those banks that will be meeting this week, what do you think investors should be considering as they try and assess now where new terminal rates are likely to end?
Yeah, that's a great question, and I think it was a surprise to everybody that the RBA raised the rates a quarter of a point. And I was talking to some people in our Sydney office a little while ago, and that was something that was quite surprising to them. So things are, we hear stories from the government on what's going on. I'll give you a little anecdote. I was in Europe until yesterday. I just came back from Europe yesterday, and I was in London. And when you're in London, there's nothing but cranes everywhere. The amount of building going on in London is crazy. And I was in Croatia, and there's cranes everywhere. The amount of building that's going on there is crazy. So you've got the UK, you've got a country in the EU. Then I was in France and I was in Spain, and there was no sign of building going on at all. So some of this is really, I think, regionalized. And if you're in the EU and you're looking at, okay, what's going to happen in rates, it's not one holistic entity. There are pockets that are doing much better than others, and that's where it becomes a quandary. Are we catering in the EU to just France and Germany, or are we looking at all of the members, and how are we treating that? So that's I think a little bit of the quandary we've got going on right now is nobody really knows, and when we start looking at these interest rate hikes, everybody keeps talking about how the economy is going to go into a recession and how this is going to be, it's going to cause us lots of problems. But, when you look at the physical evidence, there's still lots of building and lots of growth going on. So it's kind of contradictory in its nature. So, but I think some of the interest rate changes that we're seeing, or we're going to see this week, it's going to impact the currencies. And as we know, when, you see a big swing in the currency markets, there's a shift in capital as well. And where that shift happens and where it goes to, that can really impact investments everywhere.
And you will join us on that journey when we find out, David. Lovely to speak to you, as ever. Thank you very much indeed for joining us. David Pierce, Director of Strategic Initiatives, GPS Capital Markets, joining us.